Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. Hey, one of the things I love about my job is the fact that when I'm working with folks, with new people coming in particular, but my clients over time, develop a relationship where it's about attaining your goals. All right, it's fun when you're looking at all these different pieces and putting them together. And when you get that plan that allows you then to have that lifestyle that you desire, and when we do our regular reviews and we're seeing how things are going and we're seeing that we're on track to accomplish those goals and to be able again to not only just maintain your standard of living, but to increase it, to have some fun in retirement, to have some fun money that you've got in your, factored into the planning that's going to allow you to travel or do things with your grandkids or whatever it is that you enjoy. You're going to have the money to do that. Well, the investing piece, this is the engine that drives that. This is so important then to get that right. The other things that we talk about, like Social Security and healthcare costs in retirement, and how to reduce other risks that you might have, long-term care risk as an example, how to minimize taxes, how to get that estate planning, all of it plays together to make sure that you're going to have the lifestyle that you desire in retirement. Now, one of the things that comes into this, we're going back to the investing piece here, is the S&P 500 again. I'm going to show you here a chart. The S&P 500 growth to balance growth. If we look at it historically, all right, if we look over the last almost 20 years now in the stock market, we can see an average return of about 6%. Now, this is so important to understand how this works, right? And to have a historical perspective here. So when we're looking at that return on the left, we see basically that there's lots of ups and downs. We see in the 2000 through 2002 period, that bear market, right? And remember back then, that was the NASDAQ bubble bursting. And it took almost 20 years to recover from. That was 9/11. That was so many negative things that had happened, and going into a recession, of course, being one of that led to that 45% drop in the market, 46% actually drop in the market. And so if you had a $500,000 or $1 million in this situation, you'd have had about 600,000 of it left after that period, about $400,000 loss. Imagine now if you went into retirement and you hit a period like that, what that could do to you. Okay, we're going to talk about this because it's so important, and there are ways to protect yourself, and I'll show you how that works. In fact, if you look on the right, the balanced growth portfolio, this is a 50-50 portfolio of stocks to bonds. In that portfolio over the same period, right, it was about a break even. It was down hardly at all. And the very next year then it recovered. So when we get into time horizons, normally we talk about rolling 10-year averages, and what that means is that if you're in the market for at least 10 years, you got a 95% chance of a positive result. But look what happened from 2000 through 2009. We had that bear market from 2000 through 2002. Then we had a bit of a bull run up till October of 07, and then the market took a dive, and we had one of the worst years in the market in 08. We hadn't seen a year that bad since 1933. Right? And so just when we're back up and making a little bit of money on our portfolio, boom, we get hit again, and we're down about 400,000 again. And then it takes about 5 years to recover. And this is one of the things that we want to look at is, if we look on the other hand on that balanced growth, so here's us 10 years in the market, and I actually had a negative result. There's that 5% instead of the 95. But that same period, 2000 through 2009, I made money in the balanced growth portfolio. Okay? I came out, in fact, I averaged, I think it was around 5% a year over that period. Now, if we look at that then in the long term, this is a way that you can protect yourself. This is one of the defensive strategies. So even when it peaked in 07 and 08, it took that hit. It only lost about half as much, and it recovered in about half the time, 2 versus almost 5 years. So this is one of the things when you get into portfolio design, it's so important. This is a way that you can more safely invest in the market through a truly diversified portfolio with the asset allocation model done. And this is done again based on 60 years of Nobel Prize-winning, easy for me to say, right, academic research. And we're utilizing Dr. Eugene Fama, won a Nobel Prize in 2013, developed what's called the 3-factor model. Just to let you know, there's a lot of substance to how these are put together. There's a lot of history, a lot of back testing that's been done to arrive at these portfolio mixes. And when we look at the market now in the last almost 10 years, we see that, again, longest bull market in history. And what do we see with that? Even with that, an average on 12% a year over that period, we still had 2 years that did zero. And of course, then this year looks to be very much like another 0 year, or possibly a little negative, possibly a little positive. It's not going to be much, whatever it is, right? Not likely with just a few weeks to go. So if we understand how the markets work and that 1 in 4 years are typically negative years, and we properly set up our portfolios to help protect us against downturns, then there's some other strategies that we're going to use as well. All right, so that, when you look at this, the next piece that's so important, that 2000 through 2009 period, right? That was the lost decade. That was one of the worst 10-year periods in history. And what was it preceded by? The 80s and the 90s, the two strongest back-to-back decades in the history of the market, when we had 10 and 12% average returns, when we had double-digit returns over a 20-year period. And I remember, I was, back in the mid-90s, I'm working with clients, and we were used to getting these kind of returns, and our planning was based on being able to do that forward. And then we realized, too late, it seems, in 2000, right, what would happen there. Fortunately, we still use defensive strategies to help protect against these unforeseen things. But that 2000 to I remember people coming into my office in 2000 and 2001 in particular, saying, when are things going to get back to normal? Back to these double-digit returns instead of these losses. So even with the proper asset allocation model, where we're able to minimize that loss and protect against it and recover faster, it's still not double-digit returns, is it? And so when we're looking at this period, this last decade, where we've got a 12% average return, we want to keep in mind what happened in the 10 years prior, and that the average over that longer period is more like about 6%. And to further reinforce that, people like Jack Bogle, the founder of Vanguard Funds, BlackRock, the company that is the biggest money manager in the world, okay, Dr. Robert Shiller, Nobel Prize winner in 2013 in economics for his Shiller-Cape Index, a very accurate predictor of the market in 10-year returns. And McKinsey, a large research firm, international research firm, all of them are pretty much pointing to the same thing. Those are just some examples, but they're saying basically over the next 10 years, expected rate of returns around 4.5–5% from the stock market. Okay, so now we look at the 20 and it says, kind of keeps studying it. We're reverting to that average. So that's seeming to make sense, isn't it? So when we're setting up a plan, we want to keep these things in mind. We want to we're going to put together the best plan for you, but we want to be realistic in terms of what those returns are and what that's going to look like for you as well. All right. One of the things that can mess up a plan, we can get rid of that chart for now. One of the things that can mess up a plan, if you're paying too much in taxes, how do I minimize taxes? Especially, right, you've got $1 million, let's say, in a retirement account, or maybe 2 or 3 million even. What happens with that money? You did not pay tax on it. So in retirement, when you start taking that money out, you're going to have to pay tax on it. If you don't, now let's say you didn't need that money right away. Well, even if you didn't need it at all, by age 70 and a half, you're going to be forced to take money out through required minimum distributions. The IRS wants to get paid those taxes. All right. So how do you minimize taxes? You have to have strategies to minimize taxes, not only when you're taking money out, but another way to look at that is tax efficient investing. Okay, so if you've got money, if it's not all just in IRAs or 401ks, but let's say you've got an investment account, how do you minimize taxes there? How do you put those things together in such a way to minimize taxes? Again, it's not just what you make, it's what you keep. If you want to keep more, you need a tax strategy, a tax planning strategy to help you minimize taxes. The other is on those returns. We're going to talk about something called sequence. I've talked about before, sequence of returns risk. This is a very real risk, in particular in retirement. So pre-retirement, if I had everything in an S&P 500 index fund, and I've got the stomach for those ups and downs, I'm going to, again, outperform 90% of equity mutual funds. And what's the other part of that? When we look at the 10% that outperform the S&P, it's not the same 10. It's not like, oh, I'll just go invest there. I tried that, by the way. It doesn't work. All right, going back about 15 years ago, close enough, yeah, about 15, 17 years ago, I used to construct portfolios using that very same strategy. I would look at who the top performers were as far as mutual funds go, and I would construct portfolios, and that's how we would invest. And then I'd get so disappointed and frustrated when they would underperform. They had outperformed the S&P 1, 3, 5, even 10-year periods, but it seemed, have you ever heard someone say, as soon as I invest in it, it's going to go down? Maybe that's something you've personally experienced. Well, that's what happens when we're looking at past performance and basing our judgment strictly on that. And that's why now, with the 60 years of academic research that we have, Nobel Prize winning academic research showing us how to construct a portfolio, right? We can beat that game. That's the winner. This is the safest way to invest in the market, and it's a way to win at the investing game. All right. So when you're looking at sequence of returns, this is another risk. So again, if I'm pre-retirement, right, I've got the S&P 500 index, I could just run with that. But if I can do even better, I can reduce my volatility and do even better, and which might help me sleep at night, right? If I'm investing in one of the model portfolios I talked about. Now, what's the other piece then? Is it's not just that investing in retirement, or excuse me, pre-retirement, we can ride out that volatility. We keep putting money in, right? We're not taking any money out. What happens in retirement? Oh, now we're going to start taking money out, aren't we? Now the wages go away, and we're going to look to our accounts that we've saved up for to be able to provide that income in retirement. So let me show you an excerpt. This is from Tony Robbins' book, Money Matters. And this is going to be a chart showing two different investors. First one being John. And let's get that up. So what we see here with John is that John invested in the market, and he had $500,000 that he had saved for retirement. He decides he's going to take about 5% a year out of that, which is about $25,000. He's going to have that increase with inflation, so it's going to go up each year to keep up the so he can keep up with the purchasing, his purchasing power, keep ahead of inflation. And John, though, unfortunately, he retires into a period like 2000, 2001, 2002, and loses 45% of his money. Plus, he's taking out 25, right? He took out about $80,000 over that 3-year period as well. So what happened to John? Well, John kept taking that same kind of income stream, going through these down years as well, and basically in less than about 18 years, John ran out of money. And he averaged, and this is the other part, he was taking a 5% distribution, he was averaging 8% a year. And we're thinking, how can you average 8% a year on your funds? And how many of you would say, wow, I'd love to average 8%, right? How can I average 8% and still run out of money? This is sequence of returns risk. This is retiring into a bear market and not being able to recover sufficiently, running out of money. He ended up getting $580,000. His original $500,000 investment completely drained. He ended up with $580,000 in income from that, and he was broke. At a time, right? Can you imagine at around age 80 that you're out of money? Now what do you do? Tough. We don't get do-overs on this, so we got to do it right the first time. Now, there's a way to protect, but we're going to go to the next one. This is showing the next investor. We need to take a break first. I'm sorry. All right, we're going to take a break. When we come back, I'm going to show you how you can reverse that. How you can, in fact, first off, I'm going to show you another investor, and we're going to show you the difference with sequence of returns. But then I'll show you some defensive strategies to help protect you in these things. So first, we'll take a break. Join me here. We'll be right back on the Retirement Report.
You've been